All right, so it's after work and you're really hungry. So you're on your way home and you think, well, I'll just pick up a pizza. So you stop in and you go pick you up a pizza. To your shock and amazement, you walk in and the pizza place only has cheese pizza. Well, that's kind of boring, isn't it? It'd be nice at least if they had something like maybe some pepperoni or some meat lovers or even a supreme pizza. Well, it's the same way for mortgages. It'd be nice if they had something other than a constant payment mortgage. But if you stick around in this video, I'm going to introduce a couple more to you. Hang tight. Okay, so turns out that there's more types of mortgages out there. And in this video, I'm going to introduce, along with a constant payment mortgage, a constant amortization mortgage and a graduated payment mortgage. And as the name sounds, in the constant amortization mortgage, it's the amortization that's held constant. Graduated payment mortgage, the payment changes, okay? Whereas in the constant payment mortgage, it stays the same. Now, this is somewhat of a long video, but if you go down into the description down below, I've got some links to some shorter videos in there if you want to go watch it. Plus, I have the really comprehensive video that's a good one if you want to go see it. Now, we're not going to build any amortization tables in this particular video. What we're going to do is just look at purely at the analysis of the fee structures along with the loan, along with even the lengths of the loan, and how does that affect the effective rate that you're paying? What's the cost associated with it, okay? And so we're going to study those side by side. Now, I hope you like the video. If you do like the video, please give us a thumbs up. Also, hit that subscribe button and hit the bell notification so you get more videos like this when they come out, all right? Starting off, we're going to hit the CPM mortgage, or the constant payment mortgage, so we're going to analyze it. Stay tuned.
Let's go take a look at it and we'll experiment a little bit. In this particular case, this loan is actually a 30-year loan with the same terms. And if you notice that the NPV is different, same thing. So in this particular case, there's also no fees. So it's 4.06 and 4.06, which is what you would expect to find. All right. We're going to go over here to this number 3 here, and you see that it's the same thing, same terms. All the terms are the same, except now we're back to that $32,000 fee that was in there. And if you'll notice, the cash flows to the bank are a little higher than they were in the 240, which is what you would expect because that mortgage was out there longer, okay? And the same thing here. Now, this one I actually changed the interest rate, and you can see how that affected your cash flows. So the effective rate here was 3.16 versus 3.0 here. So you paid 0.16% difference in incremental cost, a little bit less than what you paid at the higher interest rate. All right, let's take a look at the results of all that. Oh, by the way, let's go ahead and get this done real quick. So we're going to have to build this table out real fast. Let me go in here and grab this for us. Same thing here. All right. Okay, so we can actually compare these now fairly easy. So in our first one, which is the demo, the term was 240 months versus the 360 months. And it was a 30-year mortgage versus, I mean, this one's a 20 versus a 30-year. And you can see how the fees came out a little bit different versus the fees as they came out in the constant payment mortgage loan with no fees. And the same with a 2% fee. And here it was just a change in interest rate. So what we map out is the cash flows coming from here. Okay. Now, one of the good things that you should do and get used to when you're constructing spreadsheets is you don't hardwire really anything except for inputs that must be inputted. Those can be hardwired. But what you want to do is leave things alone up in here to where all you have to do is change the function here. So let's say, for instance, I wanted to change this one to, we'll say 5%. We can do that. Notice how it all changed here. If we built this spreadsheet correctly, then the results should have come through over here, and they did.
All right, so as you had a chance to take a look at that constant payment mortgage and analyze it, as you saw it with fees and without fees and the changing of the mortgage time, well, effective rate of that mortgage was different, isn't it? And it cost you more money based on which one you were doing. All right. So that should have been really eye opening for you as far as how a constant payment mortgage works. Turns out it also kind of works the same for the other types of mortgages as well. So let's take a look and analyze the constant amortization mortgage next.
Okay, so this cash flow reflects the fee. This is without the fee. And you can take a look at what you paid for that difference in money. So you got your 4.06 in cash or in interest, but your effective rate with the fee in it is 4.32. So you paid a difference of that. And this is also your net present value here to the bank with cash flows or with the fees, without the fees. All right. So now let's take a look at our constant amortization mortgage without fees. And you can tell from the very top, first of all, this is different. This is a 30-year mortgage. So we looked at that one. So your payments are going to be smaller, and your principal is going to be smaller too. So your amortization amount is less. But again, at the end of this, it still equals to zero. So you're amortizing constant payments. All right. Now, in this particular case, because there was no fees, the internal rate of return of those cash flows are the same, which makes sense because there's no fees involved. However, this is your cash flows for your net present value of this. Take a look at this amount right here, and let's go back down here and take a look at our constant payment mortgage. Notice that this one's a little bit more than this. It's a little bit more money in the constant payment mortgage. This brings up some serious questions that your bank may have with you because they may want some type of maintenance fee on that. They want that money. All right. So when we take a look at our second version here, it's the same thing, except this time we have a fee in it. And you paid 0.26 or 0.2 more for having that fee in there on that incremental cost of capital. All right. Let's take a look at our third term. This case, we are doing it at 3%. Notice that the amortization amount's the same, but your interest is different. Okay, so our cash flows came out different. So the cash flows to the bank are 3.18% because of the fees charged, and of course you still have, if without the fees, it'd be the effective rate would be 3.0. So you paid 0.18% on that $32,000. Is what that meant over the term of the note. So let's take a look at the results of all of this. So here's the results. In our demo, where we had a 240-month payment, we had 3.2 or 4.32% internal rate of return with a net present value of $1,284,157.39. Well, that one went wrong here. Actually, you can go in there and adjust this. Let's just format that cell real quick. We can format it to a currency. Hit OK. There we go. Looks much better. And you can study these loans as they're going across the top as we change the terms. And it gives you a lot of insight as those cash flows.
All right. So as we finished analyzing the constant amortization mortgage, one of the things you saw was also the structure of what fees, how the effect of fees were on the note, along with the time of the note, how long the length. We started off at 20 years, went to 30. One of the things you should have seen is how that affected the actual cost or the effective rate of that note. And that looked different than that constant payment mortgage if you saw that. Okay, you might go back to that section and take a look at it as well. Those are different, cost are different. All right, so on this next mortgage, we're also going to look at the next at the graduated payment mortgage. And yes, forgive me, we don't script anything around here. I'm kind of going with the flow as we do this video. But next thing we're going to do is we're going to look at the graduated payment mortgage, and we're going to analyze that. Okay, so enjoy.
And so now what we're going to do is we're actually going to look at this graduated payment mortgage versus a CPM. So this red line is a CPM. It's a constant payment. It's level, okay? But here you see the stair stepping that starts to occur, okay, in the note. So it starts off with a really low payment, and it just keeps going up until finally it comes out at the very top over here, okay? Now let's look over what happens to your mortgage amount, though, the balance on your mortgage. It kind of balloons up a little bit. It grows, and then it starts going back down. So it negatively amortizes for a while. That means the balance goes up. Let's take a look here at 2. And here we've changed it a little bit. We've added 2 points to this, and it's changed just a little bit. it's spread it out a little bit further. The stair step is a little bit flatter. Okay. Same thing on the note. You notice that the note itself is kind of flattening out a little bit more. All right. And we're going to go here to this one. In this particular case, we took a look at our constant payment mortgage. You see, here's that line, and here's the stair step incremental in the payments. All right. But in this particular case, the graduated payment mortgage loan balance is a little bit, it's more downward shaping. But look what happens. So if you've programmed your stuff right, all you have to do is change a couple factors and things work a little bit different. All right. So if we come over here real quick, and let me drag this bad boy over here so you can see it. Drag that over here a little bit better. If I go change this to, say, 10%, see how it starts to get, the hump starts going in there? So we're going to go back up to this 18%. And when I do, oops, sorry. I got that in the wrong thing. I should have been 5. Let's go here and make it 18%. See how that humps, the hump changes? And look at that, how it changes here too.
Okay, so you had a chance to look at the analysis on the graduated payment mortgage. And here, this note was very, very different than both the constant amortization mortgage and the constant payment mortgage. Very complicated. And you start to see that the little nuanced changes that you made had a great effect on that note. A great example of that was that growth rate in the payment, right? The payment growth rate. If you change that, it could actually take you into a negative amortization, or you could actually flatten out by going with smaller steps. Okay. Now, what are some of the usages of the graduated payment mortgage? Well, a great example of a graduated payment mortgage use would be in a development where you don't have any tenants and you're looking for a lease up. And as you recall from earlier videos I did, if you hadn't had a chance to look at that, there's one out there called the Nature of Finance. So if you get a chance, I recommend you watch that one. But in that video, I talk about the 3 things that finance people are concerned with, which is the magnitude of cash flows, timing of cash flows, and risk of cash flows. Well, what you want to do with a financial engineer wants to match up your cash flows with what's being expected of you on your mortgage. You don't want those ever crossing over because that just hurts you, okay? So we want to make this amicable and work for you and the bank as well. A graduated payment mortgage can do just that. In this particular case, if you're in a development, you need a lease up, it gives you a chance to get the cash flows coming into you as that mortgage is appreciating, okay? Now, the other side of that could be when we look at the constant amortization mortgage, if you remember, those payments started off up high and went down. And so in that case, you want something where you've got maybe a redevelopment project, or maybe you're selling off some of your property. And you don't need a lease up, you need to let the leases go, okay? So you want those cash flows going down. Constant payment mortgages are used primarily for mortgages in which the tenants are mature, meaning you know what those cash flows are going to be, okay? Even if you have a tenant that leaves, it's not a big deal to lease up, okay? All right, so I hope you learned a lot from this video. Again, like I said, hit that like button and subscribe button if you got something out of that. At least let me know you did well. Leave some comments below if you've run into anything similar to it. Now, also on the end card, I'm going to put the next suggested videos up for you. All right, thank you.